Hi guys. Today we will analyze Home Depot stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. Home Depot has been an average performer in the overall market. Also recent evolutions are not positive, both the long and short-term trends are negative. It is better to avoid buying stocks with negative trends. Support level is around $300. Strong support levels are around $284 and $262. Strong resistance level is around $340. The next resistance levels are around $365 and $375. In the last month the stock has been trading between $314 and $375 range, which is wide. It is currently trading near the lows of this range. The stock has an average volume of 4.2 million. This is a good sign as it is always nice to have a liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth. Even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model, discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 10% per year, for last 5 years. We see that the average profit margin of the stock has been around 10% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 105% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Home Depot Company: bad, average, and good. First scenario. Home Depot will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be a low, 2%. Future profit margin would be a low, 8%. Future free cash flow to net income rate would be a low, 75%. In this case, the fair value of the stock today would be $168. Second scenario. Home Depot will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 4%. Future profit margin would be average, 9%. Future free cash flow to net income rate would be average, 85%. In this case, the fair value of the stock today would be $227. Third scenario. Home Depot will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 6%. Future profit margin would be high, 10%. Future free cash flow to net income rate would be high, 95%. In this case, the fair value of the stock today would be $301. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 14.95. Minimum rate of return. I will use 12%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Home Depot, analysts forecast growth rate around 5% per year in next 5 years, and future P/E around 22. Again, I will use 3 different scenarios for Home Depot Company: bad, average, and good. First scenario. Home Depot will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be a low, 2%. Future P/E would be a low, 20. In this case, the fair value of the stock today would be $129. Second scenario. Home Depot will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 4%. Future P/E would be average, 22. In this case, The fair value of the stock today would be $169. Third scenario. Home Depot will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 6%. Future PE would be high, 24. In this case, the fair value of the stock today would be $219. As you can see, today the stock is overvalued, $316, even if we expect the company's high performance in future. Based on estimates for the next 5 years, the stock will show a small growth in revenue, 5% on average per year, and the stock is currently overpriced. Also, the stock's short and long-term trends are negative. I may consider buying the stock if the stock drops below $250. Company's strengths. Home Depot is the world's largest home improvement retailer. The company sells appliances, tools, paint, lumber, plumbing and electrical, garden and other home improvement supplies in a big warehouse-sized stores. About 31% of sales came from plumbing, electrical and kitchen, 29% from hardware and seasonal, 21% from building materials and 19% from paint and flooring. The limited availability of new homes is contributing to higher home prices. Home price appreciation is a fundamental driver of home improvement activity. Analysts do not expect the shortage of new homes to be eliminated anytime soon. About 70% of U.S. homes are more than 25 years old and likely in need of upgrades and repairs. The company's business with contractors remains strong and those contractors have considerable backlogs. Home Depot has a return on assets of 22% and return on equity of 1,240%. This is amongst the best returns in the industry. Profit margin of 11% is amongst the best returns of the industry. Risks. A concern is that Home Depot's sales have historically been correlated with gross domestic product. Without any way to know how long the disruptions will last, or how long the strength in the housing market will continue, company has suspended its financial guidance. Main risks are recession, lower spending on home improvement, and supply chain delays. Home Depot is vulnerable to weakness in the housing market and the economy. If there is a sudden increase in interest rates or some other event that further hurts sales, selling prices or construction activity, Home Depot would be hurt. Home Depot's primary competitive threat comes from its smaller rival, Lowe's. The company is involved in a number of legal issues that are discussed in the annual report. Future theft of customer data could hurt shopper confidence and sales. Home Depot has one of the worst debt-to-equity ratios in its industry. 90% of its industry peers require less debt for financing their operations. Based on estimates for the next 5 years, Home Depot will show a small growth in revenue. The revenue will grow only by 5% on average per year. The EPS will grow by 10% yearly. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.